Hi, my name is Leslie Jouflas of Trading Live Online, and today we're going to talk about what to buy during a recession. I'm a chartered market technician. I've got the CMT designation, and I've been in the markets for over 25 years, trading and developing trading methods. I primarily use what's called harmonic trading patterns, and I also incorporate a large amount of classical technical analysis. And I teach traders how to trade these patterns, and I also teach traders some technical analysis to strengthen their skills in that field. I've authored two best-selling books with Larry Pesavento. The first one is Trade What You See, How to Profit from Pattern Recognition. This is available now in 6 languages. And the second book is Essentials of Trading. It's not what you think, it's how you think. Unfortunately, this book is out of print, but if you come to my website, if you sign up for any of the courses, I'm going to make that available to you for free in a PDF download. I think the first thing we need to define before getting in things that you might want to be looking at for your portfolio during a recession, or maybe, right now there's a lot of talk about recession, but it's still up in the air if we're currently in a recession or we're getting close to being in a recession, or we may not have a recession at all. So we're going to look at a few things that economists look at to help guide us as we hear economic news coming out. So a recession, as defined here, is a significant, pervasive, and persistent decline in economic activity. Uh, Many of you probably remember, especially 2007, 8, and 9, and that was quite a severe recession that we had. It affected the real estate market, many people's retirement portfolios. It was a tough time for a lot of people, but they're measured from the prior expansion's peak to the downturn's trough, so from high to low. And some economists use, you probably have heard this, a general rule of 2 consecutive quarters of decline in a country's gross domestic product. And that is how they define a recession. Well, we have seen that here as of August 2022 in the United States. But again, as I mentioned, it's still up in the air as to whether we're in a recession or going to be in a recession. Another easy thing to look up is the inverted yield curve, and that's when the long-term bonds have lower yield than the short-term debt instruments, and that's something that does not occur very often. And that's predicted the last 10 recessions, and as it says, sometimes they never materialize even though there's an inverted yield curve. One thing that tends to be present when there is a recession is a high unemployment rate. And we're going to look at a chart in just a minute of that, because that really is the one thing that in today's economic picture is really not present. Currently, it's around 3.5%, and it's expected to trend around maybe 4.3% to 5% in 2023. So not an extremely high unemployment rate is expected. Here's just a graph looking at the last couple of years of unemployment, and you can see it was coming down, and the last couple of quarters, it's been hovering around that 3.5%. The August is not quite on this chart, but I looked it up, and I think it is right around that 3% mark as well. So it's still staying at very low levels. Another item to take into consideration is how long recessions last. And according to the National Bureau of Economic Research, the average recession in the United States has lasted about 17 months. The shortest one was in 2020, and that was just 2 months. If you remember, we came up to all-time highs in the markets and then rapidly declined into March of 2020, where the market then had a very rapid recovery. And the longest recession lasted more than 5 years, and that occurred way back in 1873. to 1879. So sometime, in between the shortest and the longest, but roughly 17 months is about the average. In March 2020, you can see there's the definition, the V-shaped recession. That pretty much was the March 2020. But here's some other types of recessions that you might want to take a minute to study on this slide. But we're going to move on here since we have limited time. And let's take a look now at the inverted yield curve. So here's what an inverted yield curve looks like. And this is compliments of stockcharts.com, and you can find this on their site as well. And you can compare that to the SPX, which they have here. When the yield curve started to invert back here, the market was getting close to a topping pattern before it turned to the downside. Now, not always will you see a big downturn with an inverted yield curve, but it could be something of interest to technical analysts and investors when you do see one, because it is not a normal state of the relationship between the long-term and short-term bonds. Just a quick glance of the unemployment rate. Again, this is from the National Bureau of Economic Research, and the shaded areas show us the recessions and in relationship to the unemployment rates. So back here you can see the unemployment rate spike up to a very high level, and then you have this quick turn back down to a low level of unemployment. Now, the stock market has 11 main sectors to it, and I've got them listed here, not in any particular order. And there's ETFs that you can trade related to all of these sectors. And then, of course, there's always individual stocks that you can look at within these sectors as well, and industries. So now let's take a look at a graphic look at the business cycle, because I think it's important to understand a little bit about the phases of the business cycle and how they relate to these market sectors. This slide gives us a good visual interpretation of early stages of bull markets, mid to late stages of bull markets, and then the bear markets, and what sectors correspond to each of those phases. Now, it's not always as clear cut when you're in the markets as it looks on this slide, but it's a good rule of thumb to help you be looking at different sectors at different times, especially if you can identify about which stage of the business cycle that you're in. So let's take a look at another slide. And this slide showing a sector rotation helps us to understand the relationship between the economy and the market, and the different phases and the sector rotation that tends to occur with each different phase. And when the market starts to bottom, then generally finance, technology, and cyclicals are what start to move first. So we have here the economy is in the blue line and the market is the red line. So then technology, and sometimes technology will start early as well, in the industrials, the basic materials, and you can kind of think of this of what's happening in the economy when all of these start to come back to life. Well, generally there's the credit is loosening, people are able to borrow more money, businesses can borrow more money, and usually technology is leading the way with some type of new technology that's emerging. And then, there's expansion going on in the building market and business to business and so on. And so you can see as the cycle starts to mature, then we start to see a shift into energy and the staples. And the staples are generally more of a defensive stock, and energy kind of really comes to life. And we've seen that in the last few months in the markets before the topping process. And then as we get down here, as the market starts to turn over, energy is usually still strong, and staples and healthcare. And here at the end of the cycle, you can see healthcare, utilities, and finance. So looking at the sectors such as energy, staples, healthcare, utilities, finance a little bit late maybe, but starting to look at those sectors. And if you're an individual stock picker, then you're going to want to go in and look for the strongest, the best financials in the companies. Maybe dividend paying companies would be something you'd want to look at. In a strong bear market, these companies may not be moving to new highs, but if they're paying dividends, then you might be making something on the yield from that. And they're likely, if they're going to decline, even though they're very strong companies, they're likely to decline less than the overall market. Healthcare also encompasses some other industries, and healthcare is also somewhat employment resistant, so to speak, and a little bit recession proof because people still need healthcare. There's still a demand for that, but biotechnology companies are also considered part of the healthcare sector. And currently, we're seeing the biotechs really pick up some strength. And again, it's the stronger companies that are probably going to do the best. Pharmaceutical companies also would be included in healthcare. Now, in the staples sector, of course, these are things that people need. They need food, beverages. Even though beer and alcohol tend to do well in recessions, maybe people are drinking more. Um, Personal products, household products, those tend to do well. So again, looking for the strongest companies with the best balance sheets is going to be the way to go. And these companies, types of companies, are not usually all that popular during the boom phase of the economy, but during the defensive stages, they do tend to move. And so, again, looking for the strongest ones is going to be a benefit to you. And of course, you can always look at options, buying options on the particular sectors that you're looking at. That can be sometimes a lower cost to investors than the total cash output buying per share. And bonds, of course, also can be something that investors can look at. There's a particular bond called I bonds that currently are yielding over 9%. You can just look that up. You can Google I bonds and read the description of those and see if that fits your risk and your portfolio. And the last chart today, just want to have you take a look at this chart. Again, this is from Stock Charts, and you can find this. This is called a perf chart. And this is showing us in a graphic form, everything, above this line is positive, everything below is negative. This is from October 2021 to August 5th. So if we look at the strongest sectors, healthcare, and then we have utilities, and we've got staples here, and we also have, let's see, no, wait, I think I got those backwards. Sorry about that. We have energy and staples and healthcare and utilities in that order. So you can see how strong the energy markets have been. These have been moving up for a little time now, and then staples, healthcare is just kind of starting to come up now, and utilities has also been moving for some time. Well, I hope that you found this video helpful. If you have any questions, feel free to visit me at Trading Live Online. You can find my trading courses here, or feel free to send me an email. Well, I wish everybody good luck in their trading.